In today's video, we're going to be issuing a little bit of a warning in a way. We're going to be talking about why we're not particularly keen on a group of products known as structured products. Now, they come in a number of guises, but essentially the objective is usually the same. What you'll hear is that these are products that offer some kind of limited downside but big upside potential. And they're marketed as almost being suitable for the uncertain or nervous investor. If you're not sure you want to commit to, say, a FTSE 100 investment or buying blue chip shares, and you want a bit of downside protection, structured products often claim to offer the best of both worlds. Your downside might be limited, the upside is quite significant. So why don't we like them? Well, we'll come to that in just a moment. But what does a structured product look like? Well, definitions vary. Usually the definition includes something along the lines of, this is a product whose returns are linked to the performance of an index or another security. So typically these things are set up to give you a return linked to, say, the FTSE 100 and some sort of downside guarantee, if you like. They're normally a fixed term product, so you normally have to tie your money up for a little while. And they also typically include terms covering early redemption, probably not advisable, and also how the return works if the FTSE rises or falls. So often the fact sheet is quite long, and I'd advise anyone getting into structured products to have a good old read through it and make sure they understand all the terms. Right, so what do they look like? The best way to approach this is to look at a typical example. Now, right now, there are FTSE growth plans being marketed at investors, and they come with terms something like this. So what they'll do is they'll say, okay, here's the deal. If the FTSE 100 is greater than or equal to its opening level, but in 5 years' time, then you get a bonus. So here's the plus side, if you like. You put your money in, and in a moment we'll look at how much. There's often a minimum. You put your money in, and what they're saying is, maybe what we'll do, this is the product provider and the person selling it to you, what we'll do is this. We'll take a look at the FTSE 100 in March 2011, so just a month or so away. And what we'll do then is we'll look at the FTSE again in 5 years' time, so March 2016, and we'll compare those two levels. And if the FTSE has risen between those two dates, and it's higher at the end of the 5 year period than it is at the start, you get your bonus. And the bonus might be something like this. It might be a bonus of 50% of what you invested. So, for example, if I put in £5,000, I then wait until, let's say, March 2016, the product provider will compare the FTSE then with what it is now. Currently it's just under 6,000 points, and provided it's higher, doesn't have to be higher by a specific amount, just higher, I get 50% of the sum invested. So I get my £5,000 back and another 2,500. Sounds pretty good. But let's look at some more of the terms. This is where you need the fact sheet. So maybe the FTSE is going to drop. Maybe the FTSE 100 won't be higher in 5 years' time than it is now, or at the start date, the opening level as I've called it. What if it drops? Now, an example. So the FTSE is, let's say, when we kick this product off in a month's time, the FTSE is at 5,900 points, and when the plan term finishes at the end of 5 years, the FTSE in 2016 has dropped to 5,600 points. What happens then? And the answer on a lot of plans around at the moment, and if this sounds fiddly, you're right, it is a bit fiddly. Basically the answer is this. if the FTSE drops, maybe the deal is you get your money back. So if I put £5,000 in at the start, I get my £5,000 back in 2016, but only if the drop is less than or equal to 50%. All right, and there are one or two products around offering this sort of deal. So we're saying, let's say the FTSE now, or when I open the plan in March, is at 5,900 points, and when the plan ends in 2016, the FTSE is at, say, 5,600 points. Clearly it hasn't dropped 50%, so I just get my £5,000 back. So £5,000 in, £5,000 out. However, watch out for the clause that then says, if the FTSE drops more than 50%, then your initial capital might be at risk. So then the deal might be that basically for every 1% drop in the FTSE beyond 50% of where it opened when you set up the plan, you also lose 1% of the capital invested. So on some plans at the moment, if the FTSE were to drop, say, 55%, 55% of your initial capital is wiped out. So you don't get your £5,000 back, you get less than half of it back. Now, this is typical. It's complicated and it's typical. So essentially the deal is this. You're not sure. You want to invest in the FTSE 100, but you'd rather not maybe pile into shares. So you're sold one of these plans. The idea is this. Take the FTSE in March, take the FTSE in 5 years' time, put your money in for the full 5 years. If the FTSE's up, 50% bonus. Sounds great. But watch out for what happens when the FTSE drops. And you might think, this is fabulous, isn't it? This is all right. I mean, what are the chances of the FTSE dropping more than 50% over 5 years? Surely that's a massive drop. That's not going to happen. Well, a couple of things I'd say to that. One is, the FTSE recently has been trading quite near highs for the last couple of years. 6,000 points is a reasonably bullish place for the FTSE to be. And don't forget, in the aftermath of the credit crunch, it did sink to around 3,500 points. So I'm not saying that the FTSE is going to collapse. I'm not saying that this scenario is likely, but you have to be aware that if the FTSE drops at all, you're just going to get your money back. If it drops by a significant amount, you may not even get your money back. So, okay, what's my advice? I have to say we're not desperately keen on these sort of plans, and here's why. Because this is not the only catch, and you need to look through the small print on the fact sheet to even pick this up. Okay, so what other features make us a bit nervous? Right, number one, there's a good reason why a lot of financial advisors like selling these products or marketing them, and that's because for you they're expensive and for the advisor they're brilliant. Because a product like the one I just described might have a commission rate of say 3% of the sum invested. Now you might say, well, that's all right, they just take an upfront fee and then that's it. But 3% up front is pretty hefty. Yeah, so straight away you've lost some of your initial investment. And these commission rates are designed to make the structured products attractive to the people who sell them. So that's one feature we're not so keen on. Number two, there's the lockup for say 5 years. That's a fairly long time to be locking up your money right now. Inflation's rising, interest rates are rising, there are other investment opportunities. So 5 years is a good old stint to lock your money away, especially given that your capital's not protected at the end of 5 years. So that lack of flexibility you need to think about. Because if you were to say try and pull your money out after 2 years, having changed your mind, you'll be hit with some fairly meaty redemption penalties. So that's another feature we're not so keen on. Number three, even the money back guarantee is suspicious. Here's why. Number one, read the small print. A lot of these products do put even your initial capital at risk. So do not buy one thinking the worst that happens is you get your £5,000 investment back, let's say. And even if you do get your £5,000 investment back, so you get out what you put in, over 5 years, that's rubbish. Here's why. Number one, I could be earning on £5,000 interest every year. If I just stuck my money in a bank account, after 5 years, zero risk there, pretty much. I could be earning a decent rate of return. For example, the post office is launching some bonds at the moment, some accounts that are paying an RPI linked return. I mean, if I can earn, let's say, 5 to 6% a year on my £5,000, compound at the end of 5 years, I'm going to have made a 25 or 30% return. So really, the structured product is only offering me another 16 to 20% on top for putting my capital at risk. So the 50% return sounds brilliant now, but actually over 5 years, it's not as good as it sounds. Next thing, you're not getting dividends. Both of those two things are lost. The structured product, whose performance is linked to the FTSE 100, won't pay you a dividend over the 5 years. Whereas, if you put your £5,000 into, say, an exchange-traded fund that track the FTSE, or FTSE 100 blue chips, you get dividends. So don't forget that. You are losing interest and dividends over that 5-year period, and those could be significant. Next, the minimum investment. On a lot of these plans, you have to lock up, say, £3,000 or £5,000 for the full term. You may not want to do that. You may want something a little bit more flexible. So that's another thing to think about. So what we're saying is that these plans feature some quite big drawbacks. There are reasons why we're not 100% keen on them. And to summarise, here they are. Number one, a return of 50% over 5 years is okay, but it's not fabulous when you take lost interest and dividends into account. And you won't see that on the marketing literature. Number two, your capital may well not be protected. Read the small print. And even if it is protected, getting your money back after 5 years is not a good return on investment. Number three, watch out for lock-up periods. That creates inflexibility. Bear in mind commission rates are likely to be quite high for the provider. Always worth asking your broker or IFA about those. And just think about it. You know, these products in theory are the best of both worlds, but you never get a free lunch in financial markets. So why not just take a view and commit? If you think the FTSE is going to drop, leave your money in a nice cash account earning a decent rate of return. You might even make up a good chunk of that 50% over 5 years. If you think the FTSE is going to rise, go for a nice, low-cost, cheap tracking exchange-traded fund instead. Just one last point to bear in mind. Maybe not a big risk, but it's something you've always got to bear in mind. Counterparty risk. These products are often backed by somebody else. So the brand name might say, I don't know, Legal & General, for example, but actually the product is sponsored or backed or underwritten by Lehman Brothers, who don't exist. And some investors hit exactly that problem a few years ago. If the sponsor goes bust, you may struggle to get your initial investment or your capital back. Certainly it could take some time, if indeed you can get it back at all. So always worth asking the question, who's behind this product? Who's really behind this product? And how creditworthy are they?